So you give your money to an insurance company, a particular one, there's only 7 of them in the United States. You give your money to one of those insurance companies, it goes inside of a very unique product. That product is a dividend-paying whole life insurance policy. And you're saying, life insurance, Scott? Yeah, it's life insurance. So the first hurdle for you is to get past the mental block that phrase conjures up, right? And I don't know, I mean, you can talk to some of these guys, but I don't know, Jay, how you got past that initially, but obviously you had negative thoughts about life insurance, about everybody does, right? So in some way you had to get past that, right? You would say, well, I'm gonna evaluate it critically, I'm gonna take a look at it. You know, I've had people ask me, you know, Scott, is whole life insurance good for, or good, you know, and I always qualify it, in what respect? Was it good as an investment? I'm like, absolutely not. You know, it goes down initially, so you're better off putting your money under your pillow. Well, is it good as insurance? No, it's very expensive. You can get cheaper insurance, right? So, Scott, why do you do it? This is different. So it's a very unique kind of dividend-paying whole life insurance. There are 780, 790 insurance carriers in the United States. Everything I share with you is public information. You can look it all up on Google, wherever. 7 or 8 meet the standard for banking out of 800. Okay, so it's a very unique product. People like me, there are around 300 of me in the United States. We're called an authorized practitioner. What that means is we can't shoot from the hip and say whatever we want to say. There are lots of people out there that work in the insurance and the investment space that are unregulated. So they kind of say whatever they want to say. Now technically they all have state licenses, so they can't break the law, but it gives them wide latitude as far as what they can say to a client. And for us, that's not the case. We operate as a full fiduciary, which means we must put our clients' needs above our commissions or above anything that we receive. So we put our clients first. So it's a unique product offered by a unique group of people. So what's it do? Well, you shove money into these accounts, into this unique life insurance account. They keep the life insurance portion that you have to pay in premium real small as we can. The IRS tells us how much has to be in that bucket. The rest of the money goes toward what's called paid-up additions and term insurance. The paid-up additions is pure cash to you. The term insurance is how you stop your account from becoming a modified endowment contract or becoming taxable. So again, the IRS regulates all this and tells us how to do it. So I'll draw some of this out for you so you can see it. But that's essentially what you're doing, okay? It's not some secret, you know, I've had people describe it as, Scott, we want to be part of that secret group. It's not a secret group, okay? It's very public, what we do. It's not marketed a lot, so you won't see this on the halftime of the Notre Dame game. That's not the way this works. Mostly because banks and insurance companies, by and large, don't profit from this. It's more, we drive the profit to the consumer. So if there's no profit in a big bank, they're not going to do this, okay? And by the way, I've got lots of friends, lots of clients in the banking industry. So I'm not saying that I'm nothing against that, right? It's just different. So I give you this every week. When you come in, you're going to have some kind of idea about what's happening in the economy. We're going to talk financially speaking with no bias. So I'm one of those people that I'm really apolitical. I don't like politics. I dislike both sides equally. So I think for the most part, when people go to Washington, it has some kind of transformative effect. Back me up on this. Does it change people? You give people a little bit of power, right? And it just kind of changes who they are. So what I'm going to share with you is just data, okay? So I don't have, it's not my philosophy, it's not my religion, it's not any of those things, it's just math and data. That's one of the reasons why I love this. So you'll get a piece of this every week, and then we tie the big picture of finances, what's happening in the country, into the privatized banking space specifically. So then we take that one step further if we have time, or you stay a little bit afterwards, and we can talk a little bit about what that would look like for you. So my number, if you look at that handout we gave you, my phone number's on there. If you will shoot me a text and say, Scott, you mentioned this, I want a copy of it. Or Scott, I'd like to sit down and let's have a 20-minute meeting over a cup of coffee. or Scott, I'd be interested in talking to some of your existing clients. You know, any of those things, shoot me a text and let me know what you need. And by the way, y'all, those of y'all that are active clients right now, be on your A game, because I'm going to have y'all do some teaching. So I'm going to call on you, and don't make me look bad. No pressure. Okay, so Musk's net worth is now $250 billion. It's really a lot higher than that, but he's worth a lot of money. So these equity backers are easing out of the deal, and what I started off explaining this and talking about this group, the reason why that applies to this group, you guys are going to have equity backers also. You're going to have a blend of people from the public banking space and the private banking space that will coalesce, that will collaborate together to help you acquire the things that you want to acquire as a group. So you, as a private individual, only have so much capacity as far as what you can do, right? You're limited as far as what you can do. Basically, these accounts, if you put $1 million in one of these accounts, you've got $1 million to spend, or about 94% of it. But maybe $1 million isn't enough. If that's not enough and you need a lot more money than that, that's where the group comes in. So we make the group available to you, depending upon your role and how active you want to be and what you want to be. We have some folks in here that are founders of the group. So those folks have been with us from the beginning and meet the criteria for being a founder. So you can participate in the group at 3 different levels, silver, gold, platinum. They all have monetary components with them. But anyway, so we help you kind of designate what's the best place for you. But just think big picture right now for a second. If your finances and what you want to do in life, the investments you want to make, the properties you want to acquire, the businesses you want to participate in, if all those things are limited just to what you have, then obviously it brings your options way down, right? So what we do is we put together that for the first, we're in week 21 or 22? 20? Okay, so this is week 20. You have to be in place for 6 months for a private money conglomerate to be formed. So we're about a month and a half away from that. Okay, so we're getting close. That has to be in place for 6 months for syndication to be an option. Okay, so, and there's all kinds of requirements with our group of how you do this. We have to provide a year's worth of education to clients. So all of our people coming in are the most informed folks on the planet. If they're a syndicate member, I would put those people as a client up against any commercial banker around because they know their stuff. They know how money moves, they know leverage points, they know interest rates, they know margins and cash flows. They're just experts on those things. So that's the whole goal for the group, right? If you're not part of a larger group, in this case, we're an informal group for the first 6 months, then we can be a private money conglomerate. 6 months subsequent to that, if the Lord permits, we will be a private money syndicate, okay? So that's a little bit more formal body. It's a body that's got a lot more leverage, a lot more power. There are financial tiers that I have to hit as the organizer developer, and I can tell you we were, I don't know, 3 or 4 weeks in and we hit the financial requirement. So financially speaking, we've got the backing that we need right now to allow you to participate in the group. Second thing we have to hit is that educational time piece. So the first 26 weeks of basic information, foundational, educating people what privatizing money looks like, how these accounts are structured, and how you could use it personally, right? Then the next 26 weeks after that is really focused not on the individual, but on the syndicate. So the second half of the training, and I know we've done a little bit of that up to this point, it kind of oozes out of me. So I mean, I'd like to talk about that, but I want to make sure the foundation's laid first. So we'll have some people in the group that are founders, that are really part of the money group, and other folks that are just kind of coming for the education. No matter where you are on that spectrum, that's perfectly fine. We're honored to have you, okay? So you're welcome to be here, and we'd like for you, like I said earlier, to defend 90 minutes. Y'all, just give me 90 minutes once a week and make this part of your educational platform. Okay, so back to Musk. That's how this private equity backers fit with us. You and I in this group will have the exact same thing, okay? The trial is supposed to happen fourth quarter this year. I'm real interested in the trial. I want to see what happens between Elon Musk and Twitter and how the courts rule in that case. Because the contract law is a massive thing for syndicates, okay? So we're going to deal in contracts. So everything that we do, whether it's within the syndicate, because you guys will be moving money between each other inside of the syndicate, or you'll be moving it outside the syndicate. Inside the group, what will happen is the group kind of naturally divides itself into two categories. Those two categories are the folks that have a lot of assets currently that are looking for a little bit more passive income. They want to really put their money to work. Then you've got another group of folks with inside the group that are more interested in actively building and hunting something down and still growing and expanding business. So one group has money to lend, the other group has money that it needs to borrow, right? So it naturally forms a good subsets of the group. So Musk needs $33 billion to get this. We're not sure where that's coming from yet. And Twitter shares, I don't know if y'all have seen this in the market today, they're responding well. Trump invoked the Fifth Amendment yesterday with Letitia James, prosecutor and the district attorney in New York. So that means that he's just not going to speak. So in my opinion, what you see happening politically right now is the right is chomping at the bit because they see this red wave coming in the midterms in November. The left is capitalizing off some recent wins, right? They've had some gains. They just got two large bills pushed through Congress, or they're in the process of getting these pushed through. And so they're spending more money. So the problem, and y'all, this is consistent across both political parties, they spend a lot of money. And just imagine for a second, I don't know if y'all have ever read the book Money Tree, but one of my colleagues wrote a book called The Money Tree. Great book. His name's Garrett Gunderson, and he does the same thing I do. So he helps people privatize money. But if you remember, like the idea of having a money tree, if you could take this money and you could go aside and you could buy this seed, and the seed produced this amazing tree that actually grew money. So if you had that capacity, you'd protect that tree and your access to that tree with your very life, right? Well, the way our United States economic system is set up, they have a money tree. It's called the Federal Reserve. And the Federal Reserve, most of the time, buys bonds in billion-dollar chunks at a time to infuse liquidity into the markets. Okay, that's how it works. So they're basically creating cash from nothing. Well, in 1971, if you back the truck up for a second, in 1971, they didn't have that capacity. In 1971, we had a gold standard, so all new money printed had to be backed dollar for dollar by the gold that was held at Fort Knox. And you received in your wallet. Today you don't have these, right? Anybody got any money, like liquid cash on them, real cash? Everybody carries plastic? Get some cash out of your wallet for a second. I'll have you give that to me just to make a donation every minute. So get out some cash. And tell me what denomination you have. What do you have? What do you got right there? What's that?
20.
That's a 20? Okay, what does it say at the top of that? Just in the big bold print.
At the very top it says Federal Reserve Note, the United States of America.
Stop.
Okay.
So right now our money is called a Federal Reserve Note. Okay? It used to be a silver certificate, which just meant that we had precious metals in the United States to back up all of this, right? Well, today that's not the case. So this money, today, if I take out a $100 bill, in 1971 it was really $100. It had the purchasing power of $100. Now it began to erode because of inflation, but generally speaking, $100 was $100, right? Well, today that's not the case. Today it's based upon what we feel like the financial strength of the United States is. So sometimes it's high, sometimes it's low. The dollar's been taking a beating here of late. But this right now is more, it's not as concrete as it used to be. You know, it used to be definitive, it used to be specific. It's really not that way anymore, okay? So the United States government's ability to print it for both parties is their equivalent to a money tree, right? So imagine, for me and you for a second, if this group, if we had the capacity that our legislature has today to create money, especially through the Federal Reserve. Think about that for a second. Let's say that this two groups, let's say from this side of the room was all Republican, this side of the room was all Democrat, and you know, you would argue publicly, but privately, if you all controlled the money tree, your number one goal would be what? What's your number one goal?
Protect the money tree.
Say again?
Protect the money tree.
Yes. What else? I mean, think for a second. This is real life. Now you're on opposing political sides. Let's just say for a second, right? For argument's sake. Publicly. Privately, cameras go off. We're all sitting down having a cocktail at the end of a hard day. What's your number one objective? No matter which side of the room you're on.
Make it grow.
To make it
Yeah.
high, keep it high and grow.
Yeah, harvest more money out of it.
Close. You all are all around it. Here's the ultimate goal. Remain in control. Okay? Because if we can remain in control, no matter if we differ publicly, if we can remain in control, then we have literally a bottomless checkbook. So just imagine if there is no limit. Like for the first time in my life, I've got a credit card that doesn't have a limit. I didn't even know there was such an animal. But imagine not having to pay it back. So imagine someone giving you a credit card, no credit limit, and no repayment. That's what our government has right now. Okay? Now let's take it. Tell me your first name. Sean. Okay, I'll give you a real life example. Are you from South Carolina?
I'm from
Charlotte. Okay. So if someone would come to Shonda, let's say I come and I run a shipping business. She's from Charleston. She's my congressman that represents my district. You with me? I come to Shonda and I say, Shonda, we love the work you're doing. Our company really wants to support you. We'd like to make a donation to your political action committee, to your PAC. That's largely unregulated. You can do really what you want when you're given to a PAC. So we want to make a contribution. We want to make sure that we help your re-election campaign, and we want to put your face. We want you to be the face of South Carolina when it comes to commercial revenue, particularly the shipping business. We just love the work you're doing. So I just wanted to let you know our company's going to be supportive. So obviously you'd be like, cool, I love that, right? And then comes November, I do everything in my power to buy as many votes as I can to make sure that you're reelected. I want you to stay in power. It doesn't matter which party you are or which party I am, it's irrelevant. I want you to stay in power. So if I'm successful in that in October, or in November, I'm sorry. So guess what happens in December? I send you a Christmas card. And I say, Shonda, congratulations, great win. Our state is so much better because you're in this spot. And oh, by the way, remember the project that I was telling you about with our company? Well, there are a couple of legal roadblocks that make that difficult. I'd like for you to propose some legislation that wipes those out, that makes it a little bit easier. You know, my competition, ABC Trucking or ABC Shipping, they're involved in some shady things. So I'd like for you to do two things for me, if you would, to start an investigation on ABC Shipping, and I'd like you to also maybe pave the way to make shipping a little bit easier for South Carolinians, because I know you're committed to the health of this state. Signed, Scott. Right? So what does Shonda do when she gets that Christmas card? Now think, y'all, this is real life. What I'm telling you is legit, okay? This is the way it works. What Shonda does is she's like, He contributed a lot of money. He helped me get elected. So now I'm beholden to some degree. This is the way it happens. And it always starts off being good, because I would approach Shonda saying, this is good for South Carolinians. Now, in reality, it's good for Scott, right? But I'm painting it as being good for South Carolinians, right? So she can market it that way. And then I'm crushing my competition in the meantime, because I don't want any competition. I want to be the only shipping company that's operating at the Charleston Harbor, right? So that's the way it works. And then Shonda, let's say she doesn't do it. Let's say she doesn't comply with a large funding sources request. So then March or April comes by and I see the docket of proposed legislation and I see what's happening with the investigations that are happening with this company that I want to identify and wipe out my competition. I don't see what I want to see on either one of those categories. So then there's another letter or a phone call or maybe a face-to-face at this point, right? Shonda, I'm going to be in your area. I want to come by and take you to lunch, right? So then we sit down and it's a whole different tone, different conversation at that point in time, right? Because that conversation is, Shonda, we believed in you. You made these promises and you had our support. We supported you, right? And that becomes the conversation. So no matter what side of the aisle you're on, that's what's happening economically in the United States. How much control you as a citizen have over that? How much control do you have over what just happened between me and Shonda? How much control would you as a private citizen have over that?
Just your vote.
Just your vote, and you may not even know about it, right? You may not know about it until it's late, right? So, you've heard me say for the last month in here, the United States is about to go on sale. We're entering difficult waters. Forget about what you hear on the news, y'all. I don't care what the news source is. I want you to apply such a strong filter that you look critically at everything that's happening, right? Because in reality, we've been in a recession. This is probably at least the second full quarter. Now they're saying technically, legally, we only met that definition, that definition this quarter. But that's really not true, y'all. We've been in a recession. Let me give you another real quick way that this is manipulated. They'll tell you that employment is high, right? Unemployment's low. That's a good thing for the country, right? If everybody's got a job. Well, what they don't tell you is the record area of growth in new employment is for individuals that have taken on a second job. Now listen to this. Not only a second job, but a second full-time job. So let that set in your brain for a second. So as a country, economically speaking, employment's high, right? So you got that, it's really spiking these numbers showing employment high. But is that a good thing? I mean, is it a good thing if someone's working 2 full-time jobs? And most households are 2-income households anyway. So last month alone, you'll not hear this figure anywhere else, I bet you. But you can look it up. Last month alone, we lost 71,000 full-time jobs, upwards of 50,000 a year in income. In other words, the better jobs. We lost 71,000. Okay, so our country is struggling right now. We're struggling because we came out of the pandemic. So now everything has changed. Weird protocols are in place for everybody. Supply chain shortages, and one political party, really both political parties, believe the answer to financial stress in the United States is to pump more money into the economy. So flood the economy with money. But I've given you examples before that shows you if you flood the market with money, then you don't have more money in your wallet. Or if you do, you have more money in your wallet, but the things that you buy cost more. These machines, the cost of that machine that everyone's got, that becomes more expensive the more money they flood into the market. So you say, but Scott, isn't it good I got more dollars in my wallet? The answer is, how did you get the more dollars? If you got the more dollars through a free market economy, heck yeah, that's a great thing. If you got more dollars through a government handout, that's not a good thing, because they're pumping more money into the American economy and the cost of everything goes up. The buying power of the dollar goes down. So you've got goods and services up, dollar going down. As a result, it costs me more money to buy that machine. Are you with me? So I want you to be dialed into this. And again, you have absolutely zero control over that. None. keep moving. Biden's PACT Act, that's a piece of legislation that's going forward right now for vets that were, or any first responders that were sickened in the burn pits that happened overseas. Look at the next one, what I've got bulleted there. The energy index increased by 32.9% in the last 12 months. Now, they'll tell you the real inflation rate is 8.5. What should inflation be? What should the inflation rate be?
Half.
So 4?
3 and a
Give
quarter.
me some numbers. What do you guys think? What should inflation in the United States be?
3 and a quarter, maybe.
I'm saying 2.
Here's where it should be. That's where it's been historically. That's kind of the normative. That's in the financial world. That's what we use as a client when we try to project how much will your money erode in the future. We use a little north of 2%. So this is not 6% higher. Stay with me now on math for a second. I'm going to get a little wonky and nerdy. This is not 6% higher. That's not what's happening. This is 4 times the amount. This is not addition when it comes to interest rates. You can't use adding and subtracting. You have to use multiplication. Okay, so it's the impact is significantly higher because it's multiplied. If this went from 2 to 4%, how much of an increase would that be as a percentage?
100%.
100% increase, right? If it goes from 2 to 8%, that's a 200% increase. So what that means is it hasn't gone up by 6%. That sounds okay. That means that machine, that phone, if we were to drive it down and just look at that phone, is that an iPhone? Okay, so that iPhone would have been, let's say, $1,000. I'm just throwing some numbers out there. But in that case, that iPhone is going to be significantly more expensive. And you say, well, I felt pretty good because I had more money in my wallet. But you don't. A gallon of gas, a gallon of milk. I went shopping the other day for me and JoJo, my elderly mother, and it was $250. And Jay, I didn't get hardly anything. $250 at the store. I mean, have y'all noticed? Right? We're like the little frogs in the pot where the temperature gets turned up real slowly, right? That's not what's happening. Things are dramatically more expensive. Okay, so if this is the case, this is what's called their core inflation. That's not the real number. That's what's publicized. So if you Googled on your phone right now, what's today's new CPI? What's today's new inflation rate? It'd tell you 8.5. It's a lot. Okay? What it really is, this 8.5 does not include fuel, food, and energy costs as a whole. Those 3 items, and again, y'all can look me up on any of this. Those 3 items are removed from our CPI or what we see in the real inflation numbers. So then look at your handout again for a second, please. So what's those numbers? If we just look at this, and again, y'all are not going to hear this information anywhere. I don't know anyone that's breaking out this bucket and telling you what this bucket costs. You know what's significant about this bucket? You use it every day. Every day you do this, right? Okay, so energy index increased 32.9% over the last 12 months. Now, if inflation is supposed to be here, and we're at 32%, we've never seen that before. Never. The time leading up to 1929 and the stock market crash wasn't even close to these numbers. We're way, way, way worse. And the national debt at that time, going into the stock market crash of 1929, the legendary Great Depression kicked off, was $400 and some thousand. That's what our debt was. So now check this out. To put this in perspective, it was $400K. Today, we're at 30 trillion. It's unsustainable. This is coming like a freight train. And again, but I don't tell you this to invoke fear. I think fear doesn't help people. I want you just to be informed, right? Understand how we're being manipulated in the public by both sides. Both sides are really fighting together just to remain in control of the money tree, right? So if we understand what these numbers are, really, here's what I think the conclusion becomes. Okay, Scott, I have zero control over all that stuff. I have zero control over this. So what, right? What do I do? You take immediate action over what you can control, which means you need a savings account on steroids. And I know that's not as sexy as an offshore drilling, option account, a derivatives account on the market where it goes like this every day or every hour, right? But it's constant, it's steady, and it's 100% within your control. Remember, I gave you two things a couple weeks ago. When it comes to where you put your money, there should be two things that are constant, and you should not negotiate on this. You should not give this up. The first thing should be understanding. If you don't understand where you put your money, you should stop. And I always use the example of a mutual fund because I've asked people before, explain your mutual fund to me. Explain it. And most people cannot. A lot of people that came from my background in financial services, they couldn't even explain it. Take a look at a prospectus and let me know if you could explain it. It's a challenge, okay? So if you don't understand it, then don't put a lot of money there. The second thing is, if you don't control it, those two characteristics should be part of wherever you put your money. If you can't control it, why send your money off to somewhere that it could evaporate? Why do that? Why not have a piece of your money, if this is your total grid right here, why not have a piece of it that looks like that? That's private. It's not in the public sphere. So you control it, you know what's happening with it, and these accounts, by the way, listen to this because it's very unique. These accounts are guaranteed to grow every single day from the day you open it until you pass. These are meant to be lifetime financing cash flow systems. That's what it's designed for. Okay, so I got a couple more things that are important. So I gave you that number earlier, 71,000 lost jobs, full-time jobs last month alone. Consumer debt. Here's what people are doing. The space that is in what we would categorize as middle-income America. So they're making, as a household, between 40 and 100,000, somewhere in there as a household. Okay, this is a huge swath of America, right? Big group. So their credit card debt has gone up by 51%. Their balances. So what are they doing? They're living off a card. That's the worst response you could take right now. I remember I've been telling you guys for the last 6 weeks or so, I don't want you over your skis. I don't want you, going too fast. I don't want you leveraging everything. I don't want you stretching. I don't want you going to Vegas and 7 come 11, rolling the dice and hoping for a good return. I don't want you doing that right now. I want you pulling back. And for a corporation, if we were a corporation right now, your board of directors, I'd bring up one after another that would tell you, we need to be liquid. We need to be stable right now. Let's move to cash. Let's be ready because America's going to go on sale. All of the fundamentals in our current economy are bad. Even the employment numbers that you're made to think every week are so rosy. They're not, y'all. So again, my point in saying that is I want you guys as part of the money group, I want you to be informed. I want you to be like, yep, knew that was coming. I've told you the last 2 times before the Fed raised the Fed funds rate, I've told you before they raised it how much they were going to raise it. That's not because I'm brilliant, but I'm part of a network of folks that are in the privatized banking space that are brilliant. They've got their finger on the pulse of this. And by the way, we are very politically involved. Our CEO is on the banking subcommittee in Congress. Okay? So we're very connected. to what's going on. When new legislation comes out, we normally know it before the vast majority of news outlets know about it. So we try to stay involved. So as a result, as an extension, we try to keep you guys involved in that. So, yeah, second job, I already talked about that. Proposed inflation reduction plan, y'all heard about this? The Inflation Reduction Act, IRA. Have y'all heard of this?
No.
Y'all staying connected with what's going on in the world? Give me an uh-huh or Anybody not heard of it?
I think
Couple
I
people.
heard. Was it involving giving more money?
Okay, yeah, well, so let me give it to you real quick.
Taking more money.
So they've just proposed this. It's just passed the Senate. It's going to go to the House. They have the numbers in the House. In order to pass it in the Senate, it was a 50-50 tie. Our vice president had to come in and cast the swing vote. So it moved in the direction of passing the bill. What it involves is flooding the American economy with a lot of money for clean energy systems like solar. You get an incentive for doing solar, or if you have a windmill put up in your yard, you know, all these different kinds of things that are incentivizing clean energy. They're penalizing the coal industry and other types of industry at the same time. So all this money is being flooded into the market. A lot of it's being earmarked to go to Ukraine. Most people don't even know that. Now, I'm not anti-Ukraine, but for the love of God, why can't Americans help America a little bit first, just to become stronger for the Americans? Now, I believe, you know, I served in the military, and so I had a very global view, and I've seen these other countries, and my heart does go out to them. I want people to have help, and I don't like somebody to be bullied, right? If somebody asks me for help, I will bend over backwards to help them. But if they threaten me, it's on. I hate that personality in an individual or in a country, right? Well, Ukraine's being bullied a little bit now. They're being bullied a lot. Ukraine, they've got blood on their hands also. Okay, there's a long history with Ukraine. So I'm not saying we shouldn't be helping, but did you know that's part of the Inflation Reduction Act? Sending, you know, tens of billions with a B more dollars to Ukraine. So all these things are wrapped up and packaged in that. And Shonda, let's go back to Shonda for a second. Let's say Shonda was in the Senate, not in the House. Then I would have came to Shonda, right? Same scenario. And I said, you know that Inflation Reduction Act's coming up. What do you think about that? You like that, right? And Shonda would say, oh yeah, I like it. And so it's called pork. If you ever hear people talk about pork in legislative action or a piece of legislation, what that means is I have a pet project that I really like for my shipping company coming into Charleston. So I go to Shonda and I say, Shonda, I'd like to have this. And by the way, you know, we're really anxious about supporting you against your opponent. I know your opponent's got a lot of momentum right now, but we're really anxious about defeating that. You know, and I've got some folks that are working on, you know, digging up some stuff from your opponent's past that's not so great. So I think we can help you with this. You see, the whole thing ties together, and now I've inserted something in the Inflation Reduction Act that just benefits me as an individual. And it's almost impossible for Shonda to say no. Almost impossible. Because if she does say no, guess what I do? I go find someone else who'll tell me yes. We remove Shonda. Okay? I mean, it's crazy, but that's the way things are set up. So this Inflation Reduction Act, y'all, that name, it's almost like a comedy skit. I mean, it's the exact opposite of what they're saying. Okay, almost done with this. So Meta's the parent company of Facebook. This is Zuckerberg's company. They recently raised $10 million in bonds. What's that mean? That means he's taking on debt for some kind of acquisition. We don't really know. I mean, everybody can speculate as far as what they're buying. But we look at these large institutions because they're the ones that are really on the inside lane of what's going on economically in the United States. So if they're making moves, we kind of watch to see, let's see what they're doing. You know, why would somebody be leveraging debt right now? Where's he going with that money? Where's that money? If we follow the money, the old saying, we'll find out where what he's doing. So financing for leveraged buyouts is still difficult. That's in the American economy as of today. Leveraged buyouts just means if you've got one company that's weak and you've got another company, think Pretty Woman. Y'all remember Pretty Woman? Remember Richard Gere's role in Pretty Woman? He bought these failing companies and he would chop them up and get the money out, right? So that's a leveraged buyout. So leveraged buyouts right now are very difficult because the money supply within these companies has contracted so much, they're not as liquid as they need to be. So here's the teaching point. The teaching point for us is get liquid. Because if you're liquid right now, I'm telling you, stuff is going on sale. That machine that was increasing in price because we funneled more money into the economy, right? That thing's going to get cheap. It'll be less expensive. Stock will go on sale. I mean, all these different things you're going to see for the people that are ready. It'll be great. So, like you've heard me say over the last several weeks, this is the time for our savings on steroids. We're about to go on sale. Be ready. Okay, so let's talk some specific numbers for a second. We want you to consider. Can you draw this out for me, y'all, on your sheet? Or if you don't want to do that, just come up afterwards and take a picture with you, okay? But we want you to consider opening an account. Now, you shouldn't wait forever to do this. This is not one of those things where I was saying, today and only today, you know, in my polyester suit and my white patent leather shoes saying, today is the day, you know. That's not it. I'm not telling you that. I'm just saying, don't perpetually delay or procrastinate. That's not a healthy or positive thing for you. You don't gain anything from doing that. So do your due diligence. I would talk with existing clients. I would look stuff up. I would get that book and read through that book over and over and over again. Okay? That book should be your guide for a while to privatize money. So here's what you do. You start putting money in it. It's going to pay you at 3% guaranteed, which means it's guaranteed. Nothing can change that contractually forever. Banks do something called bowling. If you all would please write down that word. And then next to that word, I want you to write the name of your bank. Okay? You don't have to tell me who it is, but write down the word bowling. Then write your bank name down. Then sometime before next week, because I'd like you to come see us again next week. Sometime before next week, I want you to look it up. I want you to look up the amount of bank-owned life insurance, B-O-L-I, BOLI, that your bank owns. I'm 100% confident you can do that because it's required. It's public information, okay? So look this up, see how much BOLI your bank owns. Now, for somebody that hasn't heard me for the last year and a half or 2 years, somebody tell me why in the world would a Bank of America, let's say, I got accounts with Bank of America. Why would Bank of America give money to someone like me to put into an insurance product? Why would Bank of America do that?
Must be something in it for them.
Say again?
Must be something in it for Bank of America.
What is in it for them?
Guaranteed. Guaranteed.
Okay, no bank on the planet can guarantee 3%. Check me out on it. Can't happen. So what banks do is they take these mutually formed life insurance company and they shove a portion, normally between 5 and 15% of their holdings. They will shove into what's called a bank-owned life insurance policy. They do that because it helps them meet their bank charter and the regulatory requirements. Because today we regulate and look at everything in detail, right? So banks can't just go willy-nilly and do whatever they want. For a bank to be formed, they've got to meet these regulatory requirements, okay? That's BOLI. There's another one called COLI. Somebody tell me what you think that stands for.
Collateral.
Corporation. Corporate-owned life insurance, okay? This normally involves key man, buy-sell agreements, other things like that. But if you look up large corporations, again, you'll see the same thing. It's a little bit more difficult to see on a corporation, although it is still public. But look up these corporations, see how much your favorite corporation owns in life insurance. Scott, why do you put these two things up there? Credibility, right? Because if you're not familiar with this, you may think, wow, is that something good? Is that something that I should be involved with? Is that, if you have all those thoughts, and I don't do a good job of educating you and communicating with you, then it could be on me, because I may fail to show you the credibility of what we're doing. But if you can look and see your own bank has $45 million or $45 billion or whatever in, which bank is that?
That's all total.
Which one?
All the banks, all the major banks.
No,
Bank of America,
can't be.
that's just the major ones, not the side.
Okay, so what Jay just looked up, this is the total. Now I think it's much greater than this, but look at this number. $182 billion. Now I think Bank of America themselves got about 100 billion, so I don't know how that's possible. But anyway, it's a big number, okay? So you put your money in this account, 3% guaranteed, 3% dividend, which is non-guaranteed. So this is going to be between 5 and 6.25 net, if you add them together, right? So the money you put in here, if you put $1,000 in there, will $1,000, now listen to me for a second. I know we've been here a while, we're almost done. Put your thinking cap on for a second. If you put $1,000 in that account, and it pays 6% interest, at the end of the interest calculation period, I don't want to confuse you, but at the end of that period, how much money do you have in that account? You put $1,000 in, it pays 6% interest. At the end of the calculation period, just to do the simple math, how much money do you think you have in that account? Think before you answer. Think.
No, I'm confused. I'm thinking it's simple, but maybe it's not. 1,060.
Somebody jump out there and be brave. Tell me what you think.
I'm thinking 1,060.
Okay, anybody else agree, disagree?
If that's, 6% is 106.
Yeah, do you have to pay some fees? Are there some fees involved that are being subtracted?
What do you think about that, Lynn? Flesh that out for me. Tell me what you're thinking. First of all, repeat that for the group so they can hear you.
I'm just thinking I'm sure there's fees involved that aren't being accounted for there. So yeah, it's 6% interest, $60, but how much are the fees?
Okay. Any other thoughts? She's on the right track. So, to break this down for you, here's how this works. Above this bucket, which is going to give you a slew of benefits, I'll have existing clients go through these benefits with you later. But let's just say there's a bunch of them. And trust me, there are. Over the top of that bucket is an umbrella, in case you can't see my drawing. That umbrella is an IRS shelter. Okay? That IRS shelter uses two codes. Write these down for me if you would, please. 7702, 101. Those two codes are exceptions to the IRS code about how cash, listen to me, cash values being grown inside of a life insurance policy are taxed. So if you take out a life insurance policy and it's got a cash value component, Pastor, what this does, those two guidelines stipulate is what can the IRS do if you've got cash value growing inside of a life insurance policy? Everybody with me? So, they will tell us, in order for this to qualify for their favorable treatment, which is significant, okay? In order for that to happen, there must be a relationship between the cash and the death benefit. Now, before 1984, with the Tax Reform Act of 1984, you used to be able to do a death benefit. Y'all write this down if you would so you'll help understand this. A death benefit that was very low, let's say $10,000. Why would you want a low death benefit? Because they didn't care about insurance. They were sheltering money. Same thing my clients tell me today. They don't care about the insurance, right? They're legally sheltering money. So, and they would have a cash value that was extremely high, right? So it would be very cash intensive. Well, so let's just use an example. Let's say that you had a $10,000 death benefit and you wanted to put $1 million of cash in it. It's a bit of a stretch, but pretty close. You could do that before 1984. So a wealthy person would go to see their CPA or tax advisor. They'd say, where should I put my money? And there was a whole trend of this. That's why the IRS got wind of it. So they would say, put it in a dividend paying, cash value, whole life insurance policy that's produced by a mutual company. That's important. So not a stock company, but a mutual company. Because if you do that, the end result is all the money that grows in that, your basis, which is what you paid in, and all the interest on top of it are both tax-free. So people are like, woohoo! You know, I mean, it really was incredible. So people would buy this little bitty, small life insurance policy, and then they would bring this truckload of cash and they go, and stuff it in there, right? Because the cost of insurance was negligible, almost nothing. But the cash would go shoo, and the IRS couldn't touch it. Well, the IRS got wise to that. So now here's what this looks like. So write this down if you would for me, please. So now there's a relationship between the cash value and the death benefit. There's a relationship between the two. So the cash value has to be so much less than the death benefit. It can't be this. It's got to be the opposite. So if you want to put a bunch of cash in it, what's that mean?
Definitely gotta go up.
You got to have a bunch of this. Now, I've got many of my clients that aren't putting their entire paycheck, but they're putting close to it. So their life insurance premium, if they make, $500,000 a year, if that's their income, their monthly premium for life insurance is about $40,000. That's not everybody. If you make less than that, then scale it down. Do you have a question?
Yes,
Yes, go ahead.
so, you're saying that's no matter how much money they put in there, it's premium, right?
Mhm.
So is it tax-free or tax deductible, so it's not gonna be taxed, like also, if your yearly income is 100,000 and you put 100,000 into the policy, then
Right.
how much money did you make or how much money will be taxed?
Great question. So, what's the answer to that, Bernie? So if she's got 100,000, let's say hypothetically in income, and she decided to put 100,000 in,
Whatever, 80,
yeah,
whatever.
80, she puts 80,000 in premium. How is it treated tax-wise?
You will get 0 taxes on it. Once it's in there, it'll just grow.
But it needs to be mutual, what did you say?
It has to be structured properly. So it has to be from a mutual carrier. So that means there are 2 types of insurance companies. Stock companies, which like you're familiar with, you buy stock in the company, right? And they have 90-day reports that they make to their shareholders or stockholders. So they have this continual 90-day pressure in a cycle to make the numbers look as good as they possibly can. If you think back Enron, right? You're too young to remember, but there was a huge accounting mess from this company called Enron because they cooked the books because they felt the pressure every 90 days to make it look good, right? So the stock company is on one side. The other side is a mutual. And for a mutual company, you have to be a policyholder to own a piece of it. So all policyholders own part of the company, proportionally to how much you're paying, okay? So then from what Bernie said, all the money going in these accounts are post-tax dollars. So you've taken your income, done your taxes with your CPA, right? And you send a check to the IRS, right? So in other words, your taxes are paid on your income for the year. Once that happens, you take that income and you use it to privatize it. In other words, you're moving it out of the public space into the private space. It's protected, insulated. No one can see it. It's off the grid, right? So you're moving money in there. But remember, you've already paid taxes on it. You paid income tax, right? And in the United States, we got a progressive income tax scale. So the more money you make, the higher the percentage they take, right? So you paid your tax on it, the money goes in that account. Now what would happen with most accounts at that point in time, most investment accounts is like CDs, 401ks, mutual funds, IRAs, all that stuff. Here's what happens. You have what's called a basis. The basis is the money you put in it. So let's say you put 80,000 in it, and then at the end of the year, let's say that you've got 90,000 in your account. So it added 10,000 in interest. The IRS would say the 80,000 is yours because you put that in and already paid taxes on it. The 10,000, we wanted a chunk of that. So we're going to take 35% of the growth, right? That's what happens in a normal investment. With this, you don't pay taxes on the 80,000 base. You also don't pay taxes on the 10,000 profit. So the growth and the interest you do not pay taxes on. As long as this umbrella remains. If the umbrella ever goes away, tell me your first name.
Olga.
Olga?
Olga.
Olga with an O?
Oh, yes.
Okay. So Olga, if this umbrella goes away, so does the shelter and the benefit. Okay? So if there's a downside to what we do, that's one of them. Right? Because that umbrella must be present in your life forever. Now it doesn't mean you have to pay for it forever. You know, you could pay the money and let it take care of itself. It could be self-sufficient, right? Most of my clients don't do that. They don't pay for it forever. They fund it and then it's done. So there are 4 areas of taxes. Write this down if you guys would. Number one, these accounts are non-taxable every year on the growth. So just put on growth. So non-taxable on the growth. This is important for you to notice. Number two, it's non-taxable on distribution. So if you go in there, Olga, and you pull out some money, even if it's part of that $10,000 profit, non-taxable.
So the trouble with that, they're saying that I put money that I already paid taxes on.
Right.
I'm self-employed, so if I would make 500,000 per year,
Right.
and I put 400,000 before I would pay taxes, right? Because I don't pay it right away. No one
Right.
takes it out from my salary. So how is that going to be? Like, how do you calculate that?
Same way. In other words, we anticipate, doesn't matter if you paid your taxes or not, we anticipate those are post-tax dollars. So for my clients, it makes no difference at all. You're going to file, you're going to pay taxes at some point in time, but all the money that goes in that, in other words, like if you put money in a 401k, that goes in pre-tax, right? So you could say, I make $10,000 a month, take $1,000 a month and put it in my 401k. Well, they would lower your taxable income to $9,000. So before the IRS ever gets its grubs on it, they channel some of that money into a pre-tax investment, right? We don't do that. And we don't think you should do that ever, by the way. But for us, instead of $1,000 being tax deferred, you put that full $10,000 in here, not $9,000, but you put the $10,000 in it, and it is non-taxable forever. So you have to pay the taxes on it as you make it, just your regular income taxes, just like you're doing right now. So when you make income, right, whatever your business, if you're an employee, 1099 contractor, you have to pay income taxes, right? So that doesn't change. You pay that. What changes is what do you do with what's left over, right? So let me go through the rest of these. So number one, you're not paid, or you don't pay taxes on the growth. Number two, you don't pay taxes on distributions. Number three, you don't pay taxes at retirement income. So at some point in time, these accounts, the same account, by the way, Olga, that you set up for banking during your working years, will turn into a retirement distribution channel for you in retirement. Same account, right? So instead of you sending them money, they will start sending you money every month. That money on every retirement system that I know of in the United States is taxable, or a piece of that's going to be taxable. If you take an annuity, part of the annuity income is taxable. If you have a 401k or IRA, you're really going to get hit. You're going to find out how big of a partner the IRS is with you. So if you're putting money in those, you have to give advice based upon someone's specific situation. But I can tell you, generally speaking, you should have a conversation with me just to look at a comparison. Because if you're putting money right now in a 401k or IRA, I think you should stop. Okay, and I'll give you an analogy and a comparison. The fourth way, the final way, you're also not paying taxes on debt. So when that money passes to your beneficiary, it's tax-free. But remember, this umbrella is a big life insurance policy. So if you end up putting, remember this relationship? Let's say you end up putting $1 million in cash, and you can write a check today if you want. Or let's say it takes you 10 years to get there, right? However long, it doesn't matter to us. We just think you should have some money that you can privatize, and then the figures don't matter. You work that out. We'll help you. So if that's $1 million here, this over here is probably going to be 15 million. Okay? So what you just did was you changed your family tree forever. Because we're going to put in place, if you follow our counsel, inside of a properly structured trust, a $15 million estate asset. So God forbid something happens to you, then charities that you know and love, your children, grandchildren, aunts, uncles, nephews, nieces, you name it, wherever you want that to go, you leave your thumbprint on society by doing this. And we do something in particular called a Rockefeller Trust. Don't have time today, but we'll tell you about that in the future. But basically, it makes sure each generation goes up by a factor of 10. So if Olga, let's say Olga's net worth is $1 million, then Olga's children or whoever she wants to leave that money to would be a factor of 10. It'd be 10 million. Then that first generation to Olga, the next one after that, again, a factor of 10. That's 100 million. Through the miracle of insurance, right? So we don't do it for the insurance. None of my clients care about life insurance, I can just tell you. But what does it do? It protects the cash, okay? So the money grows, 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 grows. Then what happens, let me give you these numbers real quick. If you got $1 million in there, and let's say that you take out $900,000 for retirement. Let's say you build this up, you listen to Scott, and you got out of bed with the IRS. You told Uncle Sam, I love y'all, very patriotic, I'll wear my stars and stripes, but you no longer have permission to participate with me in my bank account or in my 401k, I'm out, right? So you dequalify that money, you take constructive receipt of that money, you take the hit. Now, again, I don't give tax or legal advice. Talk to your tax professional. I'll be glad to meet with them together with you if you'd like to have that conversation. But here's what happens, generally speaking. What I'm sharing with you is called common knowledge. So I can speak about this without having a law license, right? So here's what happens, or a tax license. So what happens is, if you take money out before age 59 and a half, you have a 10% penalty. So if you've got that $1 million in your 401k or IRA, you got to pay $100,000 in this example in a penalty, right? Second thing you'll have is you'll pay your income taxes at that point in time. So whatever that distribution is will be added to your income tax. Now we have some strategies called a 72T if you want to write that down. In fact, if you'll shoot me a text saying, Scott, I'd like to get more information about this, then that will trigger me, my memory, right? I have to have something in writing so it reminds me of what to do. Then I'll send it to you, or I'll schedule a time for you to meet with one of our tax professionals. So anyway, there's no taxes moving on these accounts. My clients are typically high net worth, high income folks. Doesn't mean you have to be that. They just naturally gravitate to these accounts because it protects them from the IRS. Legally walled off from the IRS, legally. So for those people, they don't want to pay the IRS any more than they legally have to, right? So it's insulated from the IRS. It's also insulated from creditors. If you're in business, a small business owner, at some point in time, it's not if, but when. Somebody's going to get upset with you. There's going to have some kind of legal action against you. We're in a very litigious society. People do this all the time. They'd rather send a letter from their attorney than sit down and have a conversation. I mean, it's crazy, right? So protect yourself. Everything you put in here is legally protected from creditors. And there's all other kinds of benefits. But anyway, so if you did this, here's what happens, Olga. That $900,000 that you've asked for your retirement, and you may take that monthly. Let's just say for illustration, you take it all at one time. You say, send me $900,000. I'm going to buy a yacht. I'm going to buy Scott a new Ferrari, you know, all this stuff, right? So you buy all this stuff, but you're taking out 900,000. Well, with any institution in the world, if this happens in August, and this happens in September, when October rolls around, Jay, you got this down? You have it? When October rolls around, any other financial institution is going to pay you interest on what balance? 100,000, right? Why? Because it's all you got left in your account. But Olga, do me a favor, write down these two words. I want you to write down the word against, then not in parentheses, and then write the other word that's important, not from. So these accounts, you borrow against them, you don't borrow from them. So no money actually comes out of this bucket ever. This is the miracle, y'all. This is, and once you get this, you may not get it now, but at 3 o'clock in the morning, you'll be laying there in bed, you'll go, ah! You'll call and say, Scott, I get it. Wait till 7. But so with this, in October, instead of just getting interest on 100,000, you get paid interest on the full $1 million. Now, in my client's life cycle, they all know this going in, but when this happens, they normally say, Scott, I wanted to give you 10,000 a month. I want to do 35,000 a month. I'm like, oh yeah, you went online, is that right? That's why, because that money never disappears. Yes, ma'am.
Once I put money in there, let's say I open the account, when can I borrow money against that money that is in there? Let's say I do it tomorrow, you made it, I wanna open the account, when
Good
will you
question.
be able to borrow money against it?
Yep, good question. Somebody answer.
The next day.
The next day.
Is your account set up? It
Me.
usually takes about 48 hours for the transfer the first time.
Yeah.
The more
So
you use it, the
you're
faster
saying
it
you
gets.
will open it for me today or tomorrow if I would choose to,
Yep.
and then I can use it, okay,
Yep.
that works.
Now let me explain something else to you. This is a life insurance product, right? So you don't qualify based on credit, although credit is a component. It's a smaller component. But for this, you qualify based on your health. So your health is the most valuable thing for privatized banking. Now, if you don't have your health, like I'm not insurable, so my health won't allow me to get coverage anywhere, even though I work with them. I can't get it, right? So I use all the people around me that I have an insurable interest in, my kids, grandkids, I use them. Should have gotten one on my ex-wife. But anyway, so yeah, anyone you have an insurable, it could be business partners, colleagues, anybody like that, right? So that process takes a little bit, not a long time, but it takes a little bit.
But once you get
How long?
the account open, then, you have that time.
That's correct. Do whatever you want to. I'm sorry.
How long?
What's an answer to that? What do you guys think?
Somebody, once you get your,
No, what she's saying, when you start, how long is the underwriting process?
It varies on the individual, their health,
It
their
is.
families, your family's health.
No, if it's just.
About a month, I guess.
It's very individualized, right? But let's
it
say,
doesn't take that long.
It
Once you
doesn't-
get your
no.
application filled out for the life insurance, and once they go through that process, they'll set up, a time for you to have your examination done.
Yeah,
And they'll-
blood, urine, they get
And
that
that's not gonna-
information. A
that's
couple
not
weeks,
long.
a couple
That's just
months
in one
max.
day. They'll get all that done, and then it'll go through underwriting.
right.
Then
Good
it's
job,
real
Mel. So
letter.
here's how that looks. So, like you've heard people say, if you're young and in great health and don't take a lot of prescription medications,
That's gonna
it
be-
normally goes shoo,
Yeah,
real
it'll
fast.
go fast.
If you're an old codger and you take a list of prescriptions this long, and you've been to a cardiologist and urologist and everybody else in the last month, then they want to see statements from those doctors. So the doctor normally slows the process down a little bit. But all that being said, for most of our clients, you can be in, and if you qualify for accelerated underwriting, if that umbrella is less than $1 million, then sometimes you don't have to do blood and urine, and you can get the policy issued. This is good information for you, Benjamin. You can get that issued in 72 hours. That's the exception, not the rule. But, so if it does require the full underwriting process, then, the things that happen is the application, like First Lady said, the application, and then you have the paramedic exam, height, weight, blood pressure, urine sample, blood sample.
Everything's
And
done.
then EKG.
Yeah,
Sometimes they'll do-
everything.
Really?
Yeah,
They do, they'll do what's called
that.
resting EKG,
Yes.
they bring all the stuff, they'll come to your house, you can go to their
You can be in that
office,
office.
whatever.
They did it 5 times on me, 5 different times.
An EKG?
I got so many policies, they killed.
He's got a large, but he runs his entire financial program. He owns multiple businesses, largest, bar in Anderson County, a large, maintenance company, so he owns a lot, so he runs stuff through that account. So in other words, the bigger, the risk for the insurance company, the more you have to do.
Me, he'll run a couple of bills through my account. Hey, but
Now you're learning.
But Scott, why are we on that? Like me, my like Blue Cross Blue Shield, my work company, they do that. They give us a reduction based on like even your mental health. They even have a psychiatrist sit down with you and determine. The lady said you're one. She said I've never met a person like you. So it was 3 facets: mental, dental, and health. Your medical.
Right.
So when they did that, then you get a reduction in your monthly premium. This is just the premium, yeah.
Correct.
And I even started doing that a couple of
Yep.
years back. But they even do that a lot because your state, by grace of God, I don't take anything. I just pray.
Yeah,
So
good.
basically, what I was gonna ask you is a 2.9 when I got my second home in 2020. Interest rates were so people were saying, don't do it. You got COVID, you got all this going on in 2020. It was
Yep.
the best time.
I
It was
know.
the greatest blessing.
That's because things were on sale.
Yeah, but people went back and had shared this with a friend of mine, and he was saying that, as a matter of fact, in 2020, people was getting money at a 3.3 and 2.9 and actually dumping money in private. He
That's
showed
right.
me this thing. He said people was actually getting hands going into debt to dump into this.
That's right.
So is that true? I was just gonna ask you to validate.
100% true, and we talk about that all the time, because you remember when I said earlier, and I know I gotta talk fast because we're out of time, but when I said earlier that America was going on sale, that's what I'm talking about, where there's real and perceived pressures, economic pressures. The real economic pressures are pretty significant. Perceived, what you're gonna hear every night on the news, everyone talking about is, wow, things are bad, and so it almost becomes a self-fulfilling prophecy at that point in time, right? So that is going to happen with the United States. How long are we going to stay there? No one knows. No one has a crystal ball. But I think we're going to swirl down. We'll hit a soft landing, which means I think we're going to be somewhere in the 15 to 20 points of the value of the market we will lose, which means 15 to 20% of your qualified accounts will go, right? So move your money out. Okay, but that's going to happen. So when that happens, things will be very, very inexpensive. So property that you were looking at that was $100,000 will be $65,000. Financing that you couldn't get before, they're going to want to move money to generate any kind of profit that they can. So when I say America's about to go on sale, it is coming. No, and I can't tell you when, but that will happen because the economic pressures. We look at the metrics underneath all these things all the time, right? We don't care about what's being said publicly. We look at the underlying data, right? And the underlying data, the amount of people that are at work right now, the amount of average debt that the consumer is paying, and what their disposable income is. If you look at those two numbers, debt and disposable income, you see how fragile we are right now, okay? Because when it comes to debt, people are, that stat I gave you on that sheet of paper, 51% more debt balances today than 12 months ago. So people are living on plastic right now. Incomes have not gone up. They're living on plastic. Cost of everything else has gone up. That is unsustainable. So there will be a cascading effect that will come from that. Okay, one more thing. Let me finish this right here. So that $900,000, y'all, won't come out of this bucket. So we're gonna fund Olga's retirement. We're gonna send it to her from the insurance carrier. Those are very, very large accounts, right? These companies are 125-year-old companies, A+ rated, the best financial companies in the world. That's gonna come to her, $900,000. It's really 3.86%, that's what they charge. But let's call it 4 to make my math easy, 4%. That means Olga's gonna have to pay $36,000 for her retirement. That's the check that she's gotta give them to get $900,000. That's the interest balance. Couple things about that. If you get a $900,000 loan from a bank, they're gonna give you a payment book and you must pay it by the 15th of every month or they're gonna come get it, right? You're gonna go to jail, right? Serious, right? Structured payments. These are unstructured, which means you can pay all of it back tomorrow or none of it back ever. All of it tomorrow, none of it ever, or anywhere
I'm
near.
not gonna let you do it.
They're not gonna come
I'm
get you.
calling you.
They're not gonna harass you. We take care of our clients. Our clients are treated with white glove treatment. So here's what happens. Let's say, Olga, that you took that $900,000 and you said, I'm gonna do what Scott said, I'm not paying a penny back ever. So they would add that interest, okay? Let's say that it grows over the years to $1 million to make my math easy. If this right here is 15 million, that's how big that umbrella is. When you pass away, what will go to your beneficiaries will then be 14 million. Because it's going to pay off that. So you've got a big, large, leveraged insurance policy. Remember, insurance policies, you pay a little bit in premium and you get a big benefit, right? So that big benefit is paying for your financing. It's paying for your lifestyle. It's paying for everything. So that 900,000 comes. Now, typically speaking, we would have you recycle that money, put that back in, pull it back out, put it back in, pull it back out, and that cycle would continue, economically speaking. So what this does is it makes this bucket, Olga, very tight. So nothing can happen to that. There are no leaks here. Like the typical financial bucket has all kinds of leaks and cracks in it. You have to pay interest charges, for stuff that you finance. You have to pay lost opportunity costs when you use your own cash. Don't use your own cash anymore. It's expensive. Don't do that. Use their cash. Because you were charged $36,000, right? Last thing. You got $1 million over here. How much is it growing at?
6%.
So what's 6% of $1 million? 60,000, right? Okay. So you got 60,000 on the plus side, 36 on the negative side. Did you win? Yes. Our clients always win. Think like a banker. Don't think like the bank customer. Thank y'all very much for being part of the money group. Sorry I went a little bit over. If you want to stay and chat with people, you're welcome to do so. Thank you very much for coming.